CIE solved past papers with explanation. Paper code 711022ON16, Commerce Lecture Online. Topic: Final Accounts of Manufacturing Business. Question number 5, year 2016, October-November attempt. Project Manufacturing Account, Project Income Statement, Project Statement of Financial Position. We are talking about Project Manufacturing Accounting question of CIE solved past papers, Commerce Lecture Online. Following balances were extracted from the books of Project Manufacturing, 30th September 2016. Capital, drawing, revenue, all are given. Purchases of finished goods, factory manager salary, office wages, premises, royalties, which is one of the important component of direct expenses and should be taken in manufacturing account, is given. Factory wages, which are also known as direct labor, rent, insurance, advertising, all these income statement expenses are given. Factory machinery, office fixtures, these are non-current assets. Provision of these two are also given. Purchases of raw material are also given. Inventory on October 1, that means the ending inventories of raw material, work in progress, finished goods are given. Provision for doubtful debt, balance is given. Trade receivable, commission received is our other income. Trade payables, bank overdraft is our liability. Additional information is given to us. Inventory on the last day of the year is raw material ending 9750, work in progress 17550, and finished goods ending inventories 4400. Expenses are to be appropriated to the factory and office as follows. Insurance 80% should be taken to the factory overhead portion of manufacturing account, and remaining 20% to be taken to the office expenses in income statement. Same proportion should be followed for the rent and premises maintenance. These percentages will be applied on the manufacturing account factory overhead portion, and these will be taken in income statement expenses portion. Administration and finance cost owing were 750. That means this expense is still unpaid. We had already paid administration and finance, and this was figured here. We'll be adding the owing amount in the previous balance. Advertising expenses 1200 prepaid. From previous advertising expenses, we'll subtract 1200 and we'll show this in the balance sheet of project manufacturing. Depreciation 20% for factory machinery using reducing balance method and 10% for office fixture using straight line method. A provision is to be maintained at 5%. We'll see its calculation in the next slides. Requirement is manufacturing account, income statement, and statement of financial position, which is known as balance sheet. Let's move to the double entry important concepts which we have to consider while preparing income statement and balance sheet. The cost which is still we are owing is the liability on us, and it should be added in our expense as well. The double entry recording of this particular information is expense debit with the same amount and payable credit. So therefore this 750 should be added in administration and finance expense, and this 750 should be taken as our liability in the balance sheet portion of our account. 1400, 1200 is still prepaid by us. So this 750 will go in the payable portion, that is the liability portion of balance sheet, and this 750 will be added in the income statement expenses portion. Advertising expense 1200 were prepaid. This 1200 will be subtracted from the advertising expense, and this 1200 will also be taken as the prepaid advertising in our balance sheet current asset portion, because all prepaids are our current asset. Let's talk about the manufacturing account for project manufacturing. Raw material consumed are first important portion of the manufacturing account. Raw material opening plus purchases of raw material will give us this amount. Raw material ending is to be subtracted, and your final answer is called raw material consumed. In raw material consumed, we have to add two things: direct labor and direct expenses. Direct labor is also known as factory wages. We'll add this. In direct expenses, we have given one expense that is known as royalties. Royalty is actually the payment which we make for any invention to its owner for reusing his invention. Without paying this, we cannot do the production. Therefore, this is considered as an important direct expense. Adding direct expense and direct wage in the raw material consumed will give us prime cost. In prime cost, we have to add all factory overheads. Factory overheads will be calculated in the proportions as described in the question. We are applying the percentages described in slide number 3 of this video. We are using these percentages for factory overhead, and we'll use these percentages when we'll take the same expenses to the income statement. So let's talk about these expenses of factory overhead. We'll calculate the amounts. Manager's salary, if the factory manager's salary will be taken here. Depreciation machinery using diminishing balance method will be calculated by us. The total of factory overhead is this amount. This total factory overhead will be added in the prime cost to finally got the cost of production. If work in progress opening is given, it will be added, and work in progress ending will be subtracted. Instead of adding and subtracting turn by turn, let's do the final calculation with the difference amount. The difference amount is greater in the work in opening, so we'll be adding the final change and we'll get our cost of goods produced as this amount. If we do not work on the change amount, you simply need to add this work in progress opening in this cost of production and subtract work in progress ending in this cost of production to get the final amount of cost of goods completed, which is also known as cost of goods produced. Without doing this amount, we cannot prepare income statement, because in cost of sales portion we have to take this amount also. So let's continue with the income statement. Revenue will come in one corner. Then we'll work on the cost of sales portion. Cost of sales portion is calculated in this internal column. Cost of sales portion always starts with opening inventory of finished goods. The cost of goods produced will be added by us here. From where it's coming? It's coming from the cost of goods manufactured statement. This is our cost of production or cost of goods produced, which we need to add in the finished goods opening inventory. If we have any purchases of finished goods, they will also be added. All these three will be added, and our closing inventory of finished goods will be subtracted from this. After subtracting this amount from the goods available, we'll finally get our amount, which is known as cost of sales. When we subtract cost of sales from revenue, we will be receiving our gross profit as our answer. So subtracting cost of sales from revenue gave us the gross profit. In this gross profit, two important portions are to be focused on. Other incomes are to be added and expenses are to be subtracted. So let's look at the other income portion. In question, they have given us commission received or commission receivable as our income. That will be written here as other income. It will be added in our gross profit, and we'll finally reach to the total income of $1,01,000. Then we'll talk about the expenses portion. All those expenses which are not directly or indirectly linked with the factory production will be listed here and will be totaled here, like insurance, rent, premises. Those descriptions which are given to us in slide number 3 related to the office, all these amounts of these expenses will be taken by us here. So income statement will include all these expenses of office. We'll calculate them, we'll take them. Office wages, salaries will come here. Advertising will also come here. This was the prepaid advertising. We'll subtract that and we'll take this 1200 in the current assets portion of balance sheet. The administration cost which we owe will be added in the previous balance, and this is the total administration and finance cost. Provision for depreciation using straight line method is calculated. Provision for doubtful debt, yes, an important calculation which we need to focus on. We calculated this amount. Trade receivable balance multiplied by rate will give us the amount which we should take as provision. We already have the beginning balance of provision as 900, so we need to increase the provision by 700. So this is how the amount of provision for doubtful debt will be taken. All these expenses will total and come here. We are subtracting the total expenses from this income. The amount which is subtracted could be written in a bracket to reveal that this is subtracted from the total incomes. From this 1,01,000, this total expenses are to be subtracted, and our final amount is called profit for the year. Our income statement is done. Let's proceed to the last requirement, that is balance sheet. Balance sheet format is here. Assets should equal to the total of capital and liabilities. Let's first work on the assets portion. Assets have two main parts, non-current asset, current asset. Let's first work on non-current asset. We want to total the net book values of non-current assets. We want this amount as the total of net book value of non-current assets, but the net book value is to be calculated by us. How will we do this? Cost of non-current asset minus accumulated depreciation of non-current asset will give you the net book value. First, we'll do this for machinery. Second, we'll do this for office fixture. These costs are given in the question. Accumulated depreciation means the depreciation given in the question plus the depreciation which we had calculated in income statement will be added. For machinery, the depreciation which we had included in manufacturing account will be added. These portions are to be ignored. Only focus on this now after calculating using these information. This is the total non-current asset. Let's talk about the total current assets now. We'll work on the first important current asset, inventory. For a manufacturing business, inventory is always given in three forms. The first form is raw material, the second form is work in progress, the third form is finished goods. We will total all these three inventories and we'll write the total inventory here. This is our first current asset. Then we'll work on second current asset, that is trade receivable. Trade receivable is this, provision for doubtful debt is this. Subtract the provision from the trade receivable and write the final current asset in the second portion. So this is our first current asset, this is our second current asset. Our third current asset is prepaid advertising. We'll list it here. These are to be totaled and written just below non-current assets, but because we have working in these two, therefore we are showing these workings in the first column. The final non-current assets total is 99,300, that is the sum of these three amounts. How we got this? After adding all three types of inventory. How we got this? After getting the final trade receivables. And this is our total current assets. Non-current assets plus current assets will give you the total assets. Half of our balance sheet is done. Let's work on the remaining half, that is capital and liabilities. Let's work on the capital portion first. Capital portion could be worked here or in this column depending on your willingness. Let's use the first column. Capital plus net profit will give you this amount minus drawings will give you the final capital amount which you need to write just below the total assets. We'll work on the liabilities portion. Non-current liabilities not given in the question, otherwise we can list down in this column or in this column and take the final amount here. Let's work on the current liabilities portion. Administration and finance payable, the amount which we still owe, we had not paid, is a liability on us, will be written here. Bank overdraft is a current liability, trade payable is a current liability. all these current liabilities will be added and listed here. In the remaining half of balance sheet, we actually need to plus final amount of capital and the final amount of total liabilities. So the capital and total liabilities will be added to find out the total capital and liabilities. After adding them, we always get the same answer as we got of total assets. Total assets are always equal to total capital and liabilities. Otherwise, there is any mistake in your statement of financial position. So this is how the working should be done and shown in a balance sheet, which is also known as statement of financial position. Like, share, subscribe for most important topics in upcoming days. Commerce Lecture Online.